Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. With the July FOMC meeting in the past now, but taper still on the minds of investors and the market, we thought it might be kind of interesting to poll some of our strategists as to the timing of taper. Taper timing, in other words. And so we're going to do that this time around with our research director, Shiraz Mian, our stock strategist, Todd Bunton, and senior stock strategist, Nick Kalivas. And Nick is a newcomer to the roundtable, so Nick, we welcome you to the discussion. In fact, going to celebrate your newcomerness by coming to you first. You feel that taper is about 50% priced into the market right now, huh?
Yeah, I do. I think that the real effect has been looking at what happened to the interest rate market and the effect that that's had on stocks that are interest rate sensitive. So you could just think of housing as the easiest example. But if you look at the relationship between kind of the Fed's balance sheet and the S&P 500, they're still both moving up in the same direction, and so there's still a large part of QE priced into the market.
All right, so let me clarify the question. Everybody knows taper is a foregone conclusion. What I should have said was, is a September taper priced in? You say 50%.
I would say after the employment report, that's gone down materially.
Really?
Yes.
So the employment report back on Friday did what?
I think that changed it probably to less than 20%.
Interesting. Shiraz, you say it's priced in. A September taper is priced in fully or not fully?
Hard to tell. I mean, that's a tough one to say. We have another jobs report just before the September meeting as well. I would agree to some extent with Nick that those hoping for the taper to be pushed back a bit got something in the Friday jobs report. But I think taper is coming. It's the odds I would put much higher than where Nick put them at 20%. It could be a smaller taper than what it was prior to the jobs report.
But in September?
But in September, absolutely. And Bernanke wants to get going on that. He has not that long left in his tenure on the FOMC and the Fed, and he wants to start that process before he becomes a lame duck in December when his replacement has been announced already. So yes, I think it is for the most part priced in.
So Todd, you don't think a September taper is priced in yet?
I don't, yeah, and I think 20%, maybe less. And if they do, like Shiraz said, it might be little.
Well, so 20% means it is priced in at 20%. Well, so you say no, though?
No, I don't think so. I think the only thing the Fed is going to taper in 2013 are its economic growth projections. I think those are way too rosy. And if you look at the last jobs report, it was the number of jobs added was below the average for the last 12 months. Yes, the headline unemployment rate came down, but again, that was driven a lot by people leaving the labor market. The labor market is not strong, and Bernanke knows it, and I don't think he's going to let off the gas pedal at all. And if he does, we might see a taper from 85 to 75. Yes, technically that's a taper, but that's still not going to be that much. And I think the market it will actually move higher on a minor taper like that.
Okay. Well, as we begin August here, stocks have posted gains 8 out of the last 9 months. So does that suggest to you guys that individual investors have now become convinced that the rally has more room to run? Nick, you say that the new high in transports, the breakout in retail, and still strong banks say that the market has more room to run.
Yeah, I mean, from that aspect, the market still has more room to run. I think the issue is that the market has not really historically done well in the last 5 months of the year. I mean, if you look at it, that has been a little bit of an issue. But the environment that's been kind to stocks remains in place. And to me, the biggest worry really is what happens in Washington when Congress gets back from their summer break and they start trying to hash out what they're going to do with the budget. But when I looked at the purchasing managers' data today and last week, those indices are pointing to better growth and maybe a reacceleration of growth. And we're also seeing Europe improve. So those are positives. I think the big hurdle really is what happens in Washington.
Today being August the 5th when we're talking here. Shiraz, you say there's a lot more market optimism out there than you're comfortable with.
Absolutely. The way I see it, the market's priced for perfection, whether it's on the economy side, on the earnings side, or the international picture. Yes, there is some green shoots on the European side, but China is iffy. The rest of the emerging markets are iffy, and yes, the U.S. picture is better, but that's just in relative terms. So if you had a 1.5% growth and you just nudge up a little bit from that in the back half, that's about all we're gonna get. It's not going to get you the 7-8% growth in earnings in the second half and the double-digit earnings growth in 2014 that everybody is banking on. And then you have this big issue with the interest rates. We have had an almost 60% jump in long-term yields over the past 2-3 months. Everybody seems to be okay with that now, hoping that the jump in yields is a reflection of better economic times ahead. But if the economic times are not better and interest rates remain high, essentially as a reflection of normalization of monetary policy, then at some stage it becomes a problem. It may not be a problem at 260 on the 10-year yield, but maybe 3.5%. So whether it's the fundamental backdrop or this monetary policy interest rate backdrop, I don't really see how the market can hold on to its gains.
Okay. Well, Todd, what do you think? As we get into August here, is the market going to be able to avoid the August doldrums that it typically experiences?
I think so, and I think it's basically just because of momentum. And I agree, the fundamental picture does not support the strength we've had in stock gains.
You actually think the top is near?
I do. I think it is coming, but I don't think it's going to be within the next couple of months. I think the momentum, and you got the retail investors starting to come back in, that can at least drive the market higher. Fundamentals be damned. But I think eventually it's earnings that are the primary driver of stocks over the long run. Those will play a bigger factor. Maybe early in 2014, I don't know, but the short-term momentum is higher. The trend is your friend, as they say, and I think that does support maybe S&P 1800, but I think that is kind of the top unless we start to see a big turnaround in earnings, which I just don't see is going to happen.
Fundamentals be damned. Did you hear that?
The arrival of the retail investor may be the contrarian sign.
That's a sign right there, yeah. But at least
for
the next couple of months, the party's going to continue. So enjoy it while it lasts.
Nick, I'm going to give you the final word. Are we going to avoid the August doldrums here?
I think August is going to be a slow rise higher. I think the problem for the market is more likely to come in September.
You say that like it's not a good thing.
No, it's just is what it is. It's summer. Yeah.
Okay.
It's summer.
All right. Well, thank you all for that. We're going to have to leave it right there. And these gentlemen are kind enough to provide their top stock picks for the week, so tune into our next segment for that.